Hi, you're watching Investor Insights, and as the first topic of discussion for 2014, I couldn't think of a better thing to talk about than the Australian dollar. More so, the Australian dollar versus the US dollar as a cross. Now, this has been one of the worst performing currencies against the US dollar the past year, and both technically and fundamentally, that cross is heading a lot lower. When you look at the technicals, all the support has been broken along the way from 105, 104, 103 straight down to now 88. 2 weeks ago it went to 88.1 something, but we're just talking a few basis points here or there. The main thing is we're looking at an 88 handle. Today we're looking at 80, 89 odd, but it's still a good 16% down from its highs last year. For those who are short the currency through warrants or other instruments, and it doesn't cost them anything, I'd stick with it. The downside potential is a lot higher than the upside potential, especially given the fact that there's been some talk about tapering, although it hasn't happened. The mention of it has really affected that the Aussie dollar cross versus the US dollar. But that's actually the subject of our next discussion, so I'm gonna just leave it at that. The 30-year traded average price for the Aussie dollar versus the US dollar is actually lower than 70 cents. So any reversion back to that mean would mean that there is still 18 to 2300 basis points downside from where it is today. So you've got blue sky potential on this one. Should we return to a long-term pattern of trading of the Aussie dollar versus the US dollar. I would, if you've been short from 100 or 102 and it's now 88, you're looking at staggering profits. It doesn't matter what instruments you're using, whether it be on an FX trading platform or through installment warrants or whatever it is that you're using, or ETF, inverse currency ETFs, doesn't matter. You're sitting on staggering profits. And even looking at 89 today, if you're happy taking profits at 80, then that's another 10%. And 10% on a trading platform is basically 10 times your return on a leverage of 100. If you're looking at warrants, you're still looking at 10 to 20% downside on the currency, which means on 10% you're going to be returning easily 10 to 20% depending on the leverage on your warrants. But whatever happens, you've got the full blessing of Glenn Stevens and the RBA for a lower Australian dollar. Fundamentally, the currency is flawed. The currency has only been able to reach parity and beyond because of the Fed's quantitative easing measures, and also because there's a belief that the mining supercycle is going to go unabated forever and ever. So stocks like BHP have run up from 7 through to 50 odd. But when people realize that everything has been done for the US on a give-only basis with no return, people are now waking up to the fact that the future isn't so bright. So looking at that Aussie dollar cross, fundamentally the economy is in real recession. The government statistics are not saying that. They're actually applauding that this is the only country that hasn't had a recession in 22 or 23 years. Whatever stats that they wish to dig up and throw at you, it never looks at inflation and a real rate of inflation. So yes, we may have shown a tiny fraction percentage of growth, but that's just probably inflation masquerading as growth. Fundamentally, every sector outside mining is in deep recession. It doesn't take a genius to work out that the employment situation is getting worse, the unemployment rate is going up, and the employment situation is the biggest gauge into an economy, as you know. So if the stated employment numbers are heading over 7%, and the real rate of unemployment is probably close to double that, then you're looking at an economy which, as the mining supercycle is subsiding and has probably ended, there is not much upside to this Aussie dollar, or subsequently you should say to the Australian economy, and that will be a subject for another video. So fundamentally, as Australia already is in a real recession, but on nominal terms we're just hovering above neutrality or just breaking even, you can say that the Aussie dollar is not going to have too much footing to stand on. If you're short, if you've got intentions to short it, you could probably pick a point higher than this. If you're trying to trade it, well, I can tell you there's a lot of volatility that's about to come. So as people wake up to the fact that the US dollar is worth the good old TP, you may see bounces in this Aussie dollar. So if you want to play this game, you can easily make money going long the Aussie dollar versus the US dollar, and you're going to make money going short just as well. So this is a really good time to be trading this currency pair, but for most people who don't want to trade or who don't want to stomach this volatility, if you've, as I said before, if you've been short from over 100 or over parity, you should be sitting very pretty on your profits. You should be considering taking some off the table. But if you've been a long-term short like I have, well, just stick with it. But essentially, if you do see 80 or below 80, and that fall, if it crosses 80, it's going to be precipitously. You're not talking about a slow grind down. Then yeah, the next target would be 75, at which you would definitely be exiting the position. And that trade comes with a caveat, and that is, as soon as you see a reversal because there's a run on the US dollar, you should get the hell out. Because if there is a run on the US dollar, this Aussie dollar could spring, I mean, these are uncharted territories, but you could be looking at 20 or 25% in a matter of no time. So technically, the downtrend is very strong, and all supports are being taken out every other day. We're now sitting only about 100 basis points off another 4.5-year low. Fundamentally, it is just as flawed. So when you have fundamentals actually working with technicals, you have got one hell of a good trade and one big drop that's going to keep on going and going and going and going until such times as I said before, there's a run on the US dollar, or there could be a bounce due to some good data out of China or whatever. Because don't forget, in September, I think it was, when the flash PMI data out of China came out positive. The Aussie dollar went from the high 88s or 89s straight back to 97, but it gave up those 900 basis point gains in a matter of a month over December. So as quick as it goes up, it comes down 3 times quicker. This goes for stocks, bonds, and the like, even real estate. So beware. If you go long this currency against the US dollar, its foundation is like a house of cards, and as quick as it goes up, it can collapse 3 times quicker. So essentially, keep on shorting it, and if you're really short, well, stay with it, and if you're happy with the profits, by all means take it, or take some money off the table.